I want to start with this question of, was the Fed chair kind of like the three Goldilocks and the three bears, right? Was he too cool? Was he very dovish? Was he too hot? Was he hawkish? Or was he kind of Goldilocks right in the middle?
Well, my take on it was that he was right in the middle. It was a balanced, I thought, measured, and not in some respects non-committal performance today. He certainly did acknowledge the growing disinflation. That's a very good thing, and that's new. He said something to the effect that this is the first time I've been able to say this, but at the same time, he said our job is not done. The Fed's job is not over, and suggested that there will be more rate hikes and that they're going to keep watching inflation very carefully. It's too early to react to what they've seen so far.
You know, I want to bring in somebody I think you know well because you used to work with him, and that's Vince Reinhart, who was the head of the Division of Monetary Affairs of the Board of Governors. He's now at BNY Mellon and Dreyfus, and he was on with us yesterday, and he said that what the Fed's going to do with this meeting is just try to get through to March, because March is when they're going to update their view of the economy. We're going to see where inflation is, and if they do need to signal more rate hikes or steady or maybe even less. Did Powell achieve that goal? Because he was asked a lot of different questions where he seemed to sort of leave it open.
Well, he achieved the goal of getting through this meeting without necessarily signaling or having the markets misinterpret terribly what he had to say. As I said, they're feeling their way along. They're in a new phase in many respects. The first phase was get to neutral. The second phase, I think you could argue, was to get into restrictive territory. Now they believe they are going truly meeting by meeting, and they probably need a little bit more restrictive stance of policy. And in March, we'll learn a lot. We'll learn a lot about how they actually see this play ending, meaning how they actually, when they're closer to it, see a stopping point, a hold period, and then ultimately a pivot to easing.
Is there still a sense that the markets think that the Fed chair is bluffing? I mean, they're definitely not folding. This is the first gain we've seen for equities on a Fed day since back in July, right? Is there a sense that the market is thinking about the fact that Fed Chair Powell is keeping that optionality, that he doesn't see rate cuts as a base case for this year?
It's sometimes difficult for me to understand the mind of the markets, and I thought it was an interesting comment he made. It's a little bit offhand comment. He said, we have different jobs. The central bank has a different job than people who are practitioners in the market. I thought the discussion of financial conditions as determined by the markets was rather interesting. He didn't go very far, but he did say they're not aligned. Then it would be ideal if they were aligned. And then, of course, as he was making his full press conference, the financial conditions were easing to some extent. At least some of the equity conditions were easing, and the bonds were rallying as well. So I know there's frustration there. They would like to have, in the ideal world, the markets aligned with what the Fed is trying to do, but there's only so much they can do about that.
So I guess the question then is how important are financial conditions for the Fed's job then?
Important, I think, very important, because they have control over the overnight rate, and they influence very strongly with the setting of the Fed funds rate, the shorter term part of the curve. But when you get out further in the curve, these are rates that are determined by markets. And as you know, we've been inverted and had an inverted yield curve for quite some time. And those are the rates that are most meaningful, I think, to the economy in the sense of car loans, mortgage borrowings, bank loans, for particularly term loans at banks. Those are the longer term rates that matter. And they, they're the ones that are going to influence the demand level in the economy to some extent.